Hello and welcome to our SmallCap Informer 2021 Outlook subscriber webinar. Thank you all for joining me. This is Doug Gerlach, the editor-in-chief and founder of the SmallCap Informer newsletter. Today we're going to be taking a look at the state of the market. We're going to be talking about some of the features of the newsletter and the website, what's new, what's been happening. We're going to take a look at the small cap market in particular. We'll wrap it up by doing a little review of our top stock picks from 2020, and then introduce our top picks for 2021, the year ahead. Those stocks that we, in our coverage list, that are poised, we think, for the best projected total return in the coming year. And already we're starting off 2021 with quite a big day for small caps so far today. The S&P Small Cap 600 index is up more than 5%, and some of our small cap stocks are up as much as 10% on the day. So big small cap rally happening today. Must be all the excitement that we're generating from our subscriber webinar. I'll be joined today by Russell Malley, who has been serving as our analyst for the Small Cap Informer newsletter, assisting me and providing coverage for the companies that we follow. He's been in that capacity for the last couple of months. He's in the back office, and you may hear from Russell with answers to questions as well. I'll do my best to address as many of your questions as I can, so feel free to use that questions box to type in your questions at any point during the presentation. I also will direct you to the handouts tab, where you can find a PDF handout of the slides from today's presentation. And at the end of each, there's two versions. One that's 2 pages, 2 slides per page in color, and another that's 4 slides per page in black and white. So you can download both of them, or if you want to print one or view one, you have some options there. And both of them include my top picks for 2021 listing as a separate page at the end. So you won't have to squint your eyes to read the small type in the PDF handout. And with that, let's get started and talk about where we are relative to 2020 and 2021. Just a little introduction. I am the president of iClub Central, which is a wholly owned for-profit subsidiary of Better Investing, the national nonprofit investor education organization. I'm the founder and the editor-in-chief of the Small Cap Informer, which is in its 10th year in 2021. So we've been, it seems like time flies, but we're into volume 10 of the Small Cap Informer newsletter. So we've got some validated results that we can share with you about the performance in that time. I'm also the editor-in-chief of our investor advisory service stock newsletter, which we're very proud was named to the Holbert Investment Newsletter Honor Roll for the 11th consecutive year for 2020-2021. We produce at iClub Central a whole product line of software and tools for investors and investment clubs. I'm the author of 6 books, as well as a lot of the content that you read on our blogs and social media for all of our products and tools, and a frequent presenter at various conferences. So we may have met around the country in my travels with the AAI and Better Investing Money Show, retail investor conferences, and much more. So that's just a little bit about me, but we're here to talk about small cap stocks. And now's a good time to take a look back at the 2020 crazy dumpster fire of a year as it relates to the stock market. I like to track 3 segments of the global market: the S&P 500, which represents large cap domestic stocks; the EFA, which is the Europe, Australasia, Far East Index, that represents large cap stocks in the developed countries around the world; and then the S&P Small Cap 600 Index, which represents small companies in the US. And as you can see, I don't want to churn up any unpleasant memories, but back in March, all 3 of these global indexes did decline significantly, triggering a bear market, which didn't last for very long. The market proved to be quite resilient. Investors put their cash back into the market after the sell-off, taking advantage of bargains, and the market has plowed its way upwards and eked out a gain for the year of over 16% for the S&P 500, which is pretty phenomenal coming from a 20% plus drop off. The EFA index has been trailing the U.S. markets for some time, ended the year on a positive note at about 8%, 8.1%. And the small caps made a big recovery towards the end of the year, ending up 9.4% for the entire year, continuing a trend of outperformance for large cap stocks. But the fact that we ended 2020 on a positive note was one bright sign for the year and a great way to end 2020, be done with it, and look forward to what 2021 may bring. My takeaways on the 2020 market performance is that there were a lot of companies in many sectors that held steady or benefited from the pandemic in some way, including companies relating to work from home and benefiting from social lockdowns, e-commerce especially, and low interest rates. Low interest rates continue to drive home building, for instance, and new home sales continue to plug upwards. The bifurcated impact of the pandemic, of course, left many service workers and white-collar workers still able to save and invest greater amounts. While a lot of people were unemployed, they tended to be blue-collar workers, workers at the lower end of the income range, and those people who were able to continue to work were able to actually save a lot more money and keep money invested in the stock market, whereas people on the lower end of the income range tend not to be as big investors, and that's a sad but unfortunate fact. So this left a lot of capital that was able to be maintained in the stock market and added to investment portfolios, even as people who were staying at home were making purchases to upgrade their homes, their household furnishings, to make additions, to build new decks, to supplement their existing homes, and that spending helped to fuel companies like Home Depot and Lowe's and create a shortage of lumber, for instance, and higher prices than usual in the lumber industry. So all sorts of odd effects of the pandemic, the recession, lower GDP, at least through the third quarter from what we can measure, and expected to be in the fourth quarter. And large caps continue to outperform. They've done this pretty much every year since 2015, and in something like 14 of the last 21 years. And that's understandable. If the big companies are performing well, and if investors are not especially concerned about performance, they don't have to trade down into the riskier, so-called riskier segments of the market represented by smaller company stocks. So there's all sorts of other factors that impacted the performance. But we do know that the PE ratio of the S&P 500 is very high relative to history. And that just points to the fact that earnings are depressed for some companies, they're holding steady for others, and investors are generally confident that companies are going to rebound, the ones that have fallen by the wayside. And so they're remaining fully invested. It's an interesting phenomena. It's hard to identify if this is the start of a new secular bull market trend, or if this is just a one-time reaction. But we've seen this whenever we've seen corrections in the last decade. We've seen investors jumping back in pretty quickly and causing those stocks to rebound. We did experience in 2020 another record, the world's shortest bear market. Well, I should say the U.S.'s shortest bear market. And again, the resilience of the market is pretty phenomenal, and is something to be respectful of, I believe. But when we look at the 20-year performance of small versus large cap stocks, you can see that small caps continue to outperform. They generate a little more volatility than large cap stocks, but the 20-year performance of small caps versus large caps is pretty compelling. And we remain convinced that all investors should maintain some exposure to small company stocks. While there will be periods of underperformance relative to large caps, in the bigger picture, small caps still are poised to deliver the best returns, the highest total returns for long-term performance. As I mentioned, from in the last 21 years, from 2020 to 2000 to 2020, the Russell 2000 index outperformed the S&P 500 in 13 of 21 years, but that's not been the case since 2015. So we're in a segment now where large caps are outperforming. I would expect that to continue in 2021, although there is room for small caps to exceed large cap performance because they've been kind of held back and ignored by the broader market. And it could be that today's action in small caps is the start of that shift, but we'll have to wait and see how that turns out. Certainly during a recession, during economic bad times, larger companies generally are a little better suited to weather the crises than smaller companies. And certainly the investors' perception that large caps are better suited helps drive their performance, whether or not it's actually the case. I would stand that many of the companies that we follow, by focusing on quality metrics, are really rated by many investors and should be valued somewhat higher, and we try to capture that discrepancy in value with the selections that we make. So let me talk about the performance of the newsletter in particular as we ended 2020. Here is a graph of our 1, 3, 5-year results as of December 31st, 2020, and the lifetime since the newsletter began on August 16th, 2012. So in the calendar year, our compound annual return of our picks was 14.1% compared to 12.3% for the S&P Small Cap 600. And again, so that's a small measure of outperformance, but that is pretty significant, and that is enough to beat ETFs that track the index, the Small Cap 600 index. Over the last 3 years, our results have been, we've outperformed 7.4 to 7.3% in the 3-year period, but in the last 5 years, the S&P Small Cap 600 actually ran it at -2% compound annual return, benchmarked to our picks, up 9.6%. And our lifetime, again, 8.3% compared to 0.4% for the Small Cap 600. So we're very pleased with this level of performance. With our long-term focus, we put greater stock in the longer-term lifetime 5-year results than near-term results. We would not expect that in every 1-year period or every year-to-date period, we would necessarily be outperforming the indexes, and we would counsel anyone to pay attention to the longer-term results. After all, we are looking to invest with a 5+ year horizon, where we do pay a little more attention to the 3 to 5 year outlook than for instance, the traditional better investing style of approach to investing, simply as a way to mitigate some of the additional volatility that comes from investing in small cap stocks. So just a couple of notes on how we measure our performance. Our objective is the S&P Small Cap 600, which we think better represents small company stocks than the Russell 2000. When you dig into it, the Russell 2000 are the 2,000 smallest companies in the Russell 3,000 or the Russell 5000 index, and the largest of the Russell 2000 stocks has something like a $9 or $10 billion market cap, which we argue is not a small company. So the S&P Small Cap 600 is a better representation of the true small company index, or rather market. We acknowledge that we might not beat the overall market. Indeed, that's not the case. We don't aim to beat the Wilshire 5000 or the S&P 500. And again, that's because of the tendency for large caps and small caps to outperform for periods of years before that switches over. And so again, that is part of our objective. But we do believe that well-diversified, long-term focused portfolios should include small as well as large companies. And so we're aiming to deliver our subscribers with those smaller company ideas. And over time, if you have a diversified portfolio, you're probably going to outperform either the small cap or the large cap markets with a diversified portfolio, certainly reducing the risk characteristics of your portfolio as you do. So let's take a look now and think about where we're headed in 2021. Both with the economy and the stock market. It's my belief that you should continue to think defensively. As I wrote in an issue or two ago, the vaccine for COVID-19 is being deployed. Sadly, it's being deployed much more slowly than had been hoped. And even if deployment picks up, it won't be until the third quarter or fourth quarter of 2021 when the vaccine will start to become available to people who are younger than 50 years old if you're not working in an essential industry or a frontline worker. And I think that that's going to continue to hold back businesses. We're going to continue to see outbreaks. Hopefully the death rate will start to recede as the vaccine takes hold in high risk populations. But so I think we have to be prepared for another 3 or possibly 4 quarters of a pandemic driven economy in terms of lockdowns and regulations being lifted, restrictions on gatherings, on the amount of people that can be in a business at any particular point in time. And then beyond that, I think we're going to have a gradual return to business as usual, which will impact businesses in the airline industry, travel industry, cruise lines, entertainment such as movie theaters, oil and gas, hotels, sit-down restaurants, large financial companies, commercial retail, real estate. It's going to be interesting to see how the work from home trend remains firmly in place, or will companies start requiring people to come back to the office? I think a lot of companies have learned, even though it might be a little painful, that if you can cut your office space by 1/3 or by 40% or 50% and save on the real estate that you're renting for offices by having a deployed workforce, that only people who need to be in the office can be in the office, providing workspace and meeting spaces in the office for when you do want to have in-person meetings and other events and team meetings, et cetera, that perhaps commercial real estate is going to experience a glut and falling prices in the next few years. Again, we haven't seen that yet. We've seen landlords still maintaining the line on the rents that they charge, and companies still, as leases become due, I think we're going to see companies reevaluating. But again, that's a large unknown. We'll have to wait and see how that trend plays out. But I certainly wouldn't be making bets against a lot of commercial and retail real estate. Bricks and mortar retail has been under pressure from e-commerce for some time, and so it's going to be interesting to see how that trend either accelerates or if people start to figure out ways to run their bricks and mortar commerce retail operations in a way that brings the traffic back in. I still think it's a good idea to be cautious when you're looking at large caps, especially those that are very overvalued. We see a lot of large company stocks I'm seeing that have very, very high relative valuations, and that just increases the downside risk. I'm glad we sort of made it through the year end without massive corrections or volatility. It seemed like the end of the year kind of just chugged along as things had been going. A little bit of a drop off earlier this week, but now small caps picking up the pace today on January 6th. Large caps, the reason I say that large caps have a large downside, one of the reasons is the Buffett indicator. This is the market cap to GDP ratio, compares the market cap of the Wilshire 5000 stock index to the nominal quarterly GDP. And as of the third quarter, you can see the Buffett indicator was at 160.3%. That has been growing since 2017 or so, but that is a much higher level than at the peak of the 1990s bull market, driven by dot-coms, driven by technology, and preceding the massive crash of the NASDAQ and the market in general, leading to a bear market in 2000. And you can see the fall off as that Buffett indicator dropped down to as low as 73% before beginning to kind of climb up again. And then we see another fall off in 2008. As the GDP, we entered another recession, so the GDP fell off. So this is not a market timing tool. This does not correlate to predicting swings in the S&P 500 or the Wilshire 5000, but it does point out that there is a lot of optimism built into the current valuation of large company stocks in the US. Again, people are big fans of Apple and Google and Facebook and a lot of technology companies that are driving the overall services economy in the US, and there just doesn't seem to be a lot of room for error. Small stumbles could have large ramifications for the valuations of the broader market. So those are some concerns that I have about large caps, and think that caution is still in order, and protection might be something that you should consider. Something like a TSLO, a trailing stop loss order, I think is especially warranted when we have overvaluation, overheated situations like we appear to have right now. I think it's a good idea to continue to maintain a defensive exposure. Defensive sector stocks tend to hold up better during perilous economic times, and providers of essential consumer goods and services are always in demand during any point in the economy. Again, I'm looking for GDP, the recession, to officially end sometime in the third or fourth quarter of 2021, as we still battle some slowdowns and pandemic-induced impact on the overall economy. But even those defensive sector stocks need to be monitored. We can't just buy companies and forget them in this particular macro environment that we're seeing right now. Consumer defensive stocks include discount stores, food distribution, grocery stores, household and personal products, packaged foods. The healthcare sector is also defensive. Biotechnology, pharmaceutical stocks, drug makers have been booming. Even as the healthcare sector is kind of battling away and deferring optional elective surgery and procedures to deal with the influx of COVID patients, but medical device makers, these are all, in drugstores, these are all considered defensive sector stocks. And utilities are also defensive. They're boring, but with their yields, they can be good cornerstones of a broader portfolio. In the small cap informer, pretty much since March, April, May, we started pivoting towards more defensive stocks, or stocks that we perceive to have advantages in the pandemic economy. And by year end, those stocks were some of our best performing companies. And very few of those, what I call the pandemic economy stocks, made it to our top stocks list for 2021, simply because they reached levels of valuation that made them not as attractive for purchase right now. So I think that, again, focus on defensive companies. These are not always the most exciting. Many times these are going to be stocks that are larger rather than small company stocks. But that is just some general guidance for your portfolio. As I mentioned, the beneficiaries of the pandemic recovery from the pandemic continue to have good potential and the new normal, whatever that looks like, it's beginning to come into focus, I believe. But big surprises for 2020, the performance of home building stocks. But again, with interest rates so low, and the traditional class of home builders, or home buyers rather, first-time home buyers, people who are securely employed and don't feel like they're at risk of losing their jobs, migrating from urban areas into the suburbs, because if you're going to work from home, it's nice to have a little more space. It's nice to have his and her offices for the stay-at-home work family. And so first-time home builders have done very well. And likewise, mortgage finance companies, even there is a risk of defaults for companies like Essent, which we have been following. We won't know the full impact of it because Essent doesn't get hit until a year or two after the defaults start to happen, when they start to have to pay out on policies. So there's, I'm optimistic about Essent. We'll talk about it as well. RVs, again, I just find it a little humorous that RV stocks have done so well, that people said, well, if I can't travel, I'm going to buy an RV. Darn it, and I'm going to take my hotel and kitchen with me and still go on vacation. And that's been quite interesting phenomenon. Robotics, IT solutions, infrastructure, those companies have all been performing well and seem to provide good opportunities as we go forward. We've started pivoting at the end of the year into some gold mining stocks. Again, good hedge against inflation, a good hedge against volatility in broader markets. And so we've got two gold mining stocks now that we're covering in the newsletter. Both of them are down for today, again, because they are expected to perform sort of with a negative beta relating to the broader market. So when other stocks are up, the gold miners will be down, and vice versa. So it's a little bit of a defensive hedge. And I still think there is room for a gold mining stock in your portfolio, just as part of that defensive sector exposure that you might want to maintain. Consider your time frame, and just we always a lot of people tend to be very optimistic about the time frame of recovery. And again, I've since the beginning have really been targeting 2021 as a recovery year, but not expecting full recovery until the end of the year or even into 2022. And so you've got to keep in mind, when you're evaluating companies for your portfolio, what is that time frame for recovery? How long is it going to take for companies to get back to 2019 level results? And watch out when buying distressed companies, because you might be sitting around a long time waiting for those companies to get back to their former glory. Being right is no good if it takes you several years to see the payback from it. And remember that our focus is on 2026. Now we're looking at where the market will be, where companies will be in 5 years, and we're not trying to time the market. As I mentioned before, one of the things we do with the small company stocks is try to pay attention a little bit more to near-term trends. If all other things being equal, if we can buy a stock that has some drivers of midterm growth as well as long-term growth, I think that's more advantageous and helps to mitigate the increased volatility in small company stocks. But we're not timing the market, and we're always looking for opportunities and remaining fully invested. And again, my message is control what you can. You can't control the market, don't sweat it, and just keep your eye on the 2026 time frame for your portfolio. So let me just take a look at the questions there. Keep those questions coming in. Russell's doing his best to answer them. Bob says he got a nice 30% gain in Norwegian cruise lines as a short-term gain. And is it a good time to sell or that particular stock? And again, I don't follow the cruise line industry, but again, there's always going to be speculation and optimism about how quickly cruise lines are going to be back into operation. But it should be clear that they're not going to be at full force in 2021. And even if, as some cruise lines have started doing cruises to nowhere, where they make no ports, they just go out on the boat and everyone's rigorously tested before and during the cruise. If you are a diehard cruiser, I suppose that might be attractive, but you're really not getting anywhere. Will the testing and vaccines, how will that impact the cruise industry? I think there are a lot of uncertainties still in relation to travel in general, requiring you to be vaccinated. Is that part of the plan that companies are looking at? Again, you're going to have to carry an ID card or some other proof that you've been vaccinated, that you're eligible to participate in some events. So there's just a lot of uncertainty there. And yeah, I'm not surprised that there have been various short-term gains to be made by speculating in some of those industries. But and it's always been said that airline stocks are not stocks to buy, they're stocks to rent, that you hold them for short periods of time and try to time getting in and out of them. And to some degree, that's the same with cruise lines. So to me, it's a big uncertainty, and because I don't follow the industry, I can't really comment any more than that. So let's take a look. We've been actively working on our SmallCap Informer website, trying to provide more resources, and some of those may make their way into the printed PDF newsletter itself, but adding to the website some tools and some additional information. I will remind you that we do have a forum there that you can post questions and comment, and if you have insight suggestions, that's a great place to post them so that other subscribers might be able to see them. And if we get some conversations going there, that can really help us figure out new features to add, as well as what are the questions that people have, what kind of factors they want to see us cover when we analyze companies. But beyond that, we've also added a calendar that we've just released. The calendar includes the ex-dividend dates and the dividend payable dates for all of the stocks that we cover in the newsletter, as well as estimated earnings reporting dates. And so those are something we're adding on a monthly basis. It's not automated, but we've been tracking it internally because it drives our publication schedule, and knowing what companies are due to report helps us plan and schedule the updates. And so we figured, well, we can add that information to the calendar, and that will make it more useful. We also will publish events and webinars on the calendar. It's available in a month view like this, as well as an agenda view, as well as a single day view. So you can view everything that's happening on a single day. So that is, again, when you come check out and download your issue each month, click on the calendar link, see what's coming up. If you're following companies, there's always going to be a lag when the time that companies report to when we cover it in the newsletter as a monthly publication, but you might want to jump the gun and take a look and get triggered when new company results are available. Those estimated earnings reporting dates are also in the company profile, and we added them to the Excel spreadsheet. So that Excel spreadsheet is the company sort table that's in each issue, and we've got some additional information on it on the spreadsheet. And one of the additional fields that we've added is now that earnings reporting date. So you can find that. As I said, we'll update it each month during when we publish the issue. We will add those estimated earnings reporting dates. And again, those estimated earnings reporting dates are subject to wide variation. Companies often will announce their dates, and we'll incorporate those when they're known. Other times the dates are based on estimates of when they reported last year, and companies, sometimes they will jump the gun results are very positive, they'll get out right away to get as much visibility for their positive results. Likewise, companies that are seeing less than optimal results from their recent quarter are going to wait until the hundreds of other companies are updating, and then they'll push out their press release kind of quietly and hope that it gets overlooked. But the estimated earnings report dates, I think, are useful. Let us know if they're not. We've also automated the performance update tracking on the website in the About section. So pretty much now on a monthly basis, we are updating the lifetime 1, 3, 5-year results. And once we get to 10 years, we'll have the 10-year results as well. And again, as I mentioned, we're benchmarking those against the S&P SmallCap 600. So the methodology for updating the performance is that we track an equal purchase of every stock recommendation, and we do that on a parallel basis into the index. Every time we have a sell recommendation, we sell the index, and in that way, we have an apples-to-apples comparison to the index. So the returns don't match a buy on the first day of the year or first day of the period of the index calculated to the last day of the period. So it incorporates all of the hypothetical cash flows. And that is how you can get a valid comparison of our actual stock picks. Now, again, we don't anticipate that everyone buys every stock, so that's so your results are likely going to be significantly different. But hopefully you're smart and you pick the ones that the stocks that perform better than the average performance of companies there. So that's the what's new on the website. We've got more development underway. I'm keeping our programmer very busy with all of our features and functionality. We do have, as one of our key products is our investment club software and our tax preparation module. So this is our tax season for investment partnership returns, and so our development team is at work hard right now getting final approvals for the IRS and all the states and releasing those. So some of the other projects have to take the back burner until tax season is over. But we do have some interesting new features underway that hopefully will help improve the value of your subscription and make it a little easier when you're making decisions. So now I wanted to give you an update on our 2020 top stocks pick. So this is the short list of stocks that we focused on, that we highlighted back at the beginning of the year, back in January of 2020. I pulled out 10 stocks that I thought were poised for the best performance in the coming year. And there were 10 stocks that were selected. We published a PDF special report that subscribers could download on the website. And so now it's time to take a look how they performed as of the end of the year. By and large, we had some great performance. We were hit hard by two of the stocks with specific pandemic-related downturns, but even Air Lease, which you would expect as an airline leasing company, was only down 1.5% for the year. It continued to pay dividends. It continues to be well capitalized. It continues to collect leases on its airlines. The airplanes that it leases to its airline customers was not especially hard hit by bankruptcies or lease cancellations. So had a big drop off, but resumed back and ended the year down just 1.5% after collecting that dividend. APTS, preferred apartments, residential, mostly residential REIT, just didn't hold up very well at all in the pandemic. They do have a segment of their business that was owning grocery store shopping plazas, and that held up very well. But the residential side, the student housing side, just did not perform well. So we discontinued that in September. At that point, it was down 44, almost 45%. Did pay some dividends during the year, during the period that we were covering it. Biospecifics Technology, up 56% for the year, was acquired. A nice exit strategy there. We were able to discontinue coverage on October 21st after the buyout was announced. Century Communities, again, up 43% for the year. If we measure from the bottom of the bear market, those gains would be even higher. But first-time home builders. So again, our thesis was that we continue to see a very hot market for first-time homes in desirable areas where Century Communities operates. This has been a great success story for us. When we first started covering them, they were one of the top 25 home builders in the country. Now they're in the top 10. So they're getting bigger, making homes that retail for under $300,000 and have quite a backlog. Little overladen with debt, but they're managing it very well. And of course, you need debt. If you're a home builder, you can't build a house until you have the property. So that's been pretty good. Essent has held their own, down 14% as a specialty finance. They make the private mortgage insurance, PMI insurance, for first-time home buyers. So supported by the boom, the continuing boom in home buyers, home buying and home building, but held back by concerns over how much will defaults cost them because they're financing homes, and there will be some people who walk away from their mortgages. And Essent's going to be on the hook to pay off those mortgages and clear out those properties. So at this point, Essent, just doesn't know. There's a 1 to 2 year period before they'll have to start paying out claims. So they're building up their bank, and we think they're in fine shape. Their low-cost operating structure allows them to be profitable, and they are invested very conservatively and well-capitalized, so we don't think it's a big problem, but they did end up down for the year. Evercore was up 50%. Capital markets had been in a downturn, had been kind of depressed, but there's been a little bit of a boom in IPOs in 2020. Who would have ever thought in the pandemic economy? But we saw a lot of companies going public, and that in general helped support that industry and boosted their results. Green Sky, another one of our stocks that didn't work out. This is the company that makes loans available to home construction companies to help the customers finance at putting in new windows, building wings, etc. Expanding into orthodontia, so dentists would be able to offer financing through Green Sky. Great technology platform. I think the company is undervalued, but you can't fight the tape, and the market says that they're not likely to perform as well in the future, and so just when stocks get down into that $4 or $5 range, it's just very difficult for them to climb out, even when the results seem to be good. So we discontinued coverage of that stock. It was down 53%. So that's kind of unfortunate. I still think there's a lot of possibility for Green Sky, and we'll keep it on our radar. NV5. Global, the construction and engineering company, down 30% for the year, or up 30% for the year. And we would expect, with some stimulus spending on a federal level, to see municipal and government projects kicking back into gear for this year. But they have performed pretty well. Owl Rock Capital paid a nice yield. This Owl Rock Capital is a company that makes loans to primarily mid-sized companies to help them grow, so the market said, "Gosh, your companies are going to start underperforming, and they're not going to be able to pay back their loans, and that's going to impact your results." Still, end of the year just down 10%, which I think is pretty good after paying out the dividend. The yield is close to 9% right now. So I think it's a pretty attractively valued at its current price and has plenty of room to grow as we go forward. And then finally, SS&C Technologies, which makes infrastructure and software tools for financial companies, investment banks, hedge funds, pension funds, mutual funds, et cetera. Up 12% for the year, including that small dividend. Again, I'm pretty optimistic about SS&C in general, but they are aggressive buyers of technology, and so I think a lot of investors look at the company and want to see more organic growth, but they are just wrapping up, and I have no doubt that within a few years, it's going to be a company on par with some of the major financial software companies providing tools for brokerage firms and back office deployment. So all in all, a lot of green on that chart, a little bit of red, but very, I think in a tough 2020 year, some of that outperformance that we saw from some of those companies, I think is pretty positive. So interesting to consider how things might have turned out without the pandemic. And I think things would have been a little bit different. But that is the update on our 2020 results. And now it's time to introduce our 2021 small cap list. We'll have a downloadable report available shortly for subscribers as an exclusive, so you can take a look at it. Again, we're looking at our coverage list, which is about 48 or 49 companies that we cover right now, looking at them from the perspective of which of these companies are poised to present the best opportunity for total return in the next 12 months. Again, our focus is on long-term, but I think personally it's useful to look at these particular companies. Maybe it's a time for a second look. Maybe it's time for you to reconsider or add to positions for some of these stocks, which are the most undervalued that we cover by and large. I did sort out a little bit of the of companies based on my projections about the performance of the economy and the need to remain defensive. But without further ado, we'll take a look at the list of 10 companies for 2021. And these are sorted by my projected 5-year total return figures. So at the top of the list is Superior Group, which is the uniform company, and also they have a division that makes branding products, so logo products and apparel for all sorts of different companies. And they have another smaller division that provides call center offsite technical support and customer support rather. And we just covered them again in the most recent issue of the newsletter. This is undercovered by Wall Street. There's only 1 or 2 analysts who cover Superior Group. They had a bang out year in 2020. They pivoted towards providing branded personal protective equipment like masks and scrubs and disposable items for protection during the pandemic, and that became just a real growth driver. So I think that provides a platform now. They've got an expanded customer base that they delivered that was very satisfied with what they got from the company in 2020. But the uniform business, I think, will start to come back in 2021 as the economy starts to come back. And so I think starting from where the revenues and earnings were in 2020, I think there's nothing but good solid growth ahead, even at just my pretty conservative 12% annual earnings growth rate. The current PE is just over 10. So as of the current price, not today's price, it's a little, I think the company's bumped up a little bit. So I think that's a interesting opportunity, and I think it's one of the best companies that we're following right now in terms of long-term results. Methode Electronics makes technology for the automotive, industrial, and medical markets. Some of those held back in 2020, but others are using kiosks. We know that cars are getting safer and safer. Autonomous driving is going to require more in the way of technology and products that are made by this particular company. They make fluid sensors, ice makers, medical bedding. So some interesting areas there. And just to give you a sense of it, in each Ford Explorer that is made by Ford Motor Company, this company provides $75 in parts. So that is not always going to be a growth business in the automotive sector, but I think there are opportunities there. Medifast performed terrifically well in 2020. This is the company that makes weight loss, fitness, weight management, consumable health, nutritional products, etc., on a direct-to-consumer sales model with coaches, 32,000 fitness and health coaches who market to local people in their local area, and just did phenomenally well in 2020. Research is showing that so far, more than 56% of people who used to go to gyms are saying that they're not planning to go back to gyms, that they've got their workout routines at home. And I think that bodes well for Medifast to continue to support people who want to be healthy, but aren't willing to go out to the gym. Here they can get routines to work out with a coach. You can provide one-on-one support virtually and help them meet their fitness goals. And I think that's going to continue to drive. The next two companies are gold mining stocks, Kirkland Lake Gold, which is a miner, and Franco-Nevada, which is a royalty company. Again, I think they're defensive. Pick and choose one of those for your portfolio. Consider holding it. I think it's something that we don't often talk about in the better investing growth stock world, but when you look at Kirkland Gold, you can really see it as the growth opportunity and learn a little bit about how to evaluate these companies. Franco-Nevada, as a royalty company, buys stakes in other gold mining companies, including Kirkland Lake Gold, which they've identified as one of the best companies that they can find in the industry. So I think that there's still room for those in 2021, especially if things start to turn south with the economy and the markets again. Those companies are going to be bulwarks that will hold up the rest of your portfolio. I talked about Essent Group, specialty finance. Again, I think that given the quality of the company's asset base and its underwriting skills, I think the market is penalizing it a little too heavily for what the expected defaults are going to be for mortgages related to pandemic and unemployment. So it's still on my list for 2021, and our companion newsletter, the Investor Advisory Service, has recently re-recommended it as well. So I think there's opportunity there. I've been a big fan of Ollie's. It is up and down like crazy, back down to the 80s, which is pretty much where it was when we picked it up, but they had a great year in 2020 as they pivoted towards providing more essential goods and services. They're reaching a size where they are not dependent solely on buying out closeout merchandise, but they can negotiate directly with big manufacturers, more of the Dollar General, Big Lots sort of model, where they can have some Ollie's branded merchandise perhaps, or their buying power just simply continues to increase. As they expand geographically, I think that benefits the company as well. And they're being held back a little bit by their expansion plans. They've got new distribution centers to support new geographic regions, but until the number of stores ramps up in those regions, those distribution centers become a little not as efficient as they're eventually going to be. And so I think there's still upside there. I'm looking at pretty moderate growth at 12.5%. McGrath RentCorp is a new holding as well. Very interesting, they make and rent modular buildings and storage containers. They've got another division that does electronic test equipment and another one that makes liquid and solid containment tanks and boxes used in the energy industry. That, of course, under pressure a little bit, but their modular buildings unit is expected to see some pretty significant growth going forward, particularly in places like California, where there's not enough schools at a primary level to serve the needs of communities. McGrath can come in and provide modular buildings that make adding those necessary classrooms on a temporary or a permanent basis quite easy. And so I think that that's a very interesting business to be in, and I see there's quite a bit of possibility there, and not a lot of value left, or there's quite a bit of value left to be unlocked in the stock price right now. Physicians Realty, ticker DOC, is the medical REIT that we started covering in 2019. Re-initiated cover, we recommended it in 2020 in the pandemic. Their specialty are medical facilities near major medical centers, so the ones that are driven by universities in many cases. So they're providing spaces for all sorts of medical practices and offices, therapists, physical therapy, x-rays and radiology, drug testing, et cetera, for businesses that want to be close to the major hospitals. And in many cases, the hospitals themselves as medical centers are the tenants because they need to have supplemental practices outside of the actual hospital buildings themselves. And again, this is just a business that will do well no matter what's happening in the real estate market or what's happening in the medical market. We bought them in 2019. They had been knocked off by the fact that some of their tenants, they had a tenant that left, and that left some pretty good big vacancies, and within a couple of months they actually had re-signed new tenants in those spaces at higher rents than they were getting before. And that's what we like to see. They're able to increase rents, renegotiate, keep market rents high, and occupancy high. Did not see very much during 2020 of tenants not being able to pay or ask for deferments, because again, these are companies that are going to do well no matter what's going on in the economy. And then finally, NV5 Global, which I continue to like. I think that in 2020, if we start to see stimulus spending kicking up, as I mentioned, this company could perform well as construction and engineering with a specialty in municipal projects and large scale construction. Highways, departments of transportation around the country utilize NV5 Global services. I think there's a lot of room for growth there, and continue to think that it's an interesting opportunity for long-term success. Kind of coming back from a period of a little bit of a weakness in the price, but I still think there's plenty of upside as we go forward. All these stocks have projected total return, including dividends, of 17% or greater, and so I think that is, I think there's some good opportunities on this list. As always, do your own due diligence and make a selection that works best for you, and follow. You can go back, refer to the SCI website for full write-ups the last time we covered each of these stocks. Bob asks, do I have a favorite between Kirkland Gold and Franco-Nevada? I think my favorite is Kirkland Lake Gold. I like it from a operating company perspective. And so for that reason, I think I like Kirkland Lake Gold a little bit better, but Franco-Nevada is more like a mutual fund in that they have ownership stakes in a bunch of different gold mining and precious metal mining operations. So that gives them a little bit of a buffer. Kirkland Lake Gold operates mines in 3 or 4 different locations. They've taken a hit this year because they made an acquisition of a mining operation that had higher all-in sustaining costs than their average for the mines that they had been operating. So input would go up, but their average costs were going to go up with the acquisition of this new mine. At the end of the day, they're still making a lot of money and still able to make money. Even if gold prices fall, they're still able to make money based on their cost structure. So I see it as pretty much a win-win. But some people, I think, prefer that diversified approach from Franco-Nevada. You've got to watch out with that P ratio of 90. That's typical for that stock, but you would want to watch that stock a little more carefully. And I think a lot of investors, our subscribers, might not be comfortable holding a stock with a PE ratio like that. It's just the nature of how that Franco-Nevada is valued. It's not a PE based on its growth rate. It's a PE based on all sorts of other factors, and I think that makes a difference. All right, before we get into some final thoughts, more questions. Walter asks about TPI Composites. Would I give us an update on TPI Composites? TPI Composites ended the year with a strong performance. This is the company that makes wind blades for other companies that make and sell wind blade. They make wind blades for companies that make the wind blade and wind blade turbines like GE and Siemens are big customers because GE can't make enough wind blades on their own equipment to support the need. So they contract out production lines from TPI Composites to manufacture for them. TPI Composites operates in a couple of different countries, including Turkey and Mexico and the United States. And so they're able to manufacture blades in locations that facilitate delivery to different regions of the world. And so for companies like GE and Siemens, they like having the ability to not have to worry about transporting from their operations wherever they might be and serve customers. But TPI Composites also has a reputation for delivering these wind blades at really incredibly fine tolerances, which makes them a very high quality operation. A couple of factors had held them back in 2019 as we headed into 2020, including some production shutdowns due to some labor problems, including closing some lines to retool them to make larger blades, which are more efficient. There's an interesting article about GE's development of wind turbine blades that are much, much larger, and those are so much more efficient the larger you can make the turbine blades of wind turbines. But they're also, require incredibly strict tolerances. So TPI was closing down its lines in order to retool them to make these larger composite blades. So that held them back. And then as we get into the pandemic of 2020, some, again, labor problems, COVID outbreaks, restrictions in various countries. I think as the year ended, they were pretty much getting back to full force and on track to meet their goal of being a $1 billion, $2 billion company in the next couple of years. And so their earnings have taken a hit due to some of those problems, but I think they're behind. Those are behind them now. And so, again, it is something of a special situation stock, but they are pretty unique in the marketplace. There are not a lot of companies that do what they do. And wind energy production is definitely on an upswing, and that is going to do nothing but benefit TPI Composites as we go forward. So I'm pretty optimistic about it, but because it is such a special situation style stock, I'm not including it in my list this year. It really requires that you kind of make some allowances if you're using a strict better investing style, toolkit 6 style approach to analysis. You really have to make a little bit of an adjustment to accommodate the company. But when you build out the model, I think it seems like it's going to be a good performer, and certainly it has done pretty well as we go forward. Bob says, any updates on Willamette Valley Vineyard? Again, just a tiny, tiny niche wine producer out in Oregon. And it's so small and it's got such a small float, it doesn't get covered by analysts or a mutual fund. Mutual funds aren't big owners of the particular company. And it's just going to take some time as they continue to ramp up. They had high hopes at the end of 2019 for a new tasting room facility that they built in Sacramento. And then the pandemic hit, and so now you've got a tasting room, a big, fancy, elegant place for people to come and sample your wares and to provide a place for people to gather and to provide gourmet food, and now you can't open it. So I'm cautiously optimistic that as they're able to reopen those tasting room experiences more fully, that might drive some incremental growth on the business. Otherwise, it's just again just a small niche company stock that I think is just very well managed and has good prospects, but it definitely requires patience if you are an investor. Okay, yes, this will be recovered. This webinar is being recorded and will be available on the website following the conclusion, so you can come back and view it there. And then generally in a month or two, we will release it to the general public once the information has had a chance to disseminate among our subscribers. So just a few final thoughts before we wrap it up. This is the time to stay the course. This is not the time to make any significant changes to your strategy, even though there may be continued uncertainty in the market, and as there might be continued wrenches getting thrown into the mix that thwart our best intentions. It's always a good idea to be able to make some micro adjustments, but don't ever take action in your portfolio out of panic. I would expect we would see another correction of 10% or more sometime in 2021. And again, we just can't predict. Nobody predicted in 2019 that 2020 was going to be a year that would be influenced by a health crisis that would impact the globe. So the signs were not there, and that is definitely the hallmarks of a black swan style event. I would also caution you, don't try to capitalize on fads and trends. Companies like Tesla, I'm pleased to see their result. I think it's a great opportunity. I'm always interested to see, Massachusetts is considering banning the sale of new gasoline-powered vehicles by 2035, and that would, those types of movements are going to continue to drive electric vehicles, and so I think that's really interesting. But again, there's so many other factors at play with these high-flying stocks. It makes it necessary that you employ some sort of stop or other strategy to protect you on the downside, because if you live by the sword, you die by the sword. If you live by trying to catch onto the latest trends and fads, you're going to suffer when those become yesterday's news. Maintain your watch list and keep on the lookout for opportunities whenever you see them presented. That's also a great plan for you. Before we wrap it up, I'm just going to flip over and take a look. This is our small cap Informer stock picks, and here we are at Yahoo Finance, and I'm looking at the daily change of all of the companies. I'm sorry that it looks like a whole lot of the companies that I pulled out in my Top Stocks 2021 list are showing up. 8% for Medifast, 8% for McGrath RentCorp, 7.6% for NV5 Global, 7.3% for Ollie's, 6.5% for Method, even TPI Composites is up 6.3%. So a lot of upside so far today. Who knows if it will hold for the rest of the trading day, but what a great way to start off 2021. And again, I apologize for if you can't buy the stock that you wanted, the price you wanted, but put it on your list and we will continue covering stocks as we go. Last question, Tracy says, do you have a rule of thumb for setting the percentage for your trailing stop loss orders? I don't, we're working on it. I'm working on some formulas and some guidance on that hopefully we'll be able to add this year. Looking at the typical variation in a stock price over a particular period. What's the biggest that the stock tends to fall during a 1 week period in the last year? So that's some guidance like that. What gets confusing is in 2020, if we look at what happened in March in a very short period, you'd be setting stop losses at 20%, and that doesn't help you. So generally somewhere in the 4 to 8% range, and is probably a good idea. But as you see, Stocks today are up 5, 6, 8%, and some stocks will decline that much in a single day, and that's kind of par for the course. The driving notion is, if you think that the stock is a little overheated, then it's a good idea to use trailing stops to protect you on the downside. If you have stocks that have a lot of embedded gains and you say, gosh, this stock is overvalued, but I don't want to sell it because it could still go up considerably, those are great opportunities to set a trailing stop loss, and you just set it. What's the price at which you'd be happy to get out of if the price started falling back? Would you give up 10% of the gain in order to exit before the stock fell anymore? Would it be 8%? You really have to make a decision based on your personal risk tolerance as you go forward. With that, hey, I want to thank all of you for being subscribers to our newsletter. I'm very pleased with the performance. I'm pleased with the reception that we've been getting for our stock picks as we have been producing this newsletter now into our 10th year. Thanks to Russell Malley in the back office for helping out. And once again, we will see you at our next webinar. We're planning our mid-year wrap-up sometime in the June-July period, so we'll look forward to seeing you there. As always, I look forward to seeing you on the SmallCap website in the forum section with any additional questions you might have. With that, thanks. Happy New Year to all of you. Stay healthy and stay the course, and we'll look forward to a much, much happier and healthier and wealthier 2021 for us all.